Good morning, and welcome to Investment Talk TV. And now, with the latest information on the stock market, your investments, and retirement opportunities, here is LPL Financial Advisor Paul Meyers.
Hey everybody, welcome to Investment Talk TV. I'm Paul Meyers, LPL Financial Advisor and President over at Legacy Wealth Management. Man, have we got an interesting show for you today. Devin and Dave have put together some questions and our typical stock market snapshot, and they're going to cover those in a couple of minutes. But I wanted to take just a minute and talk to you kind of personally about some things that might be on your mind and some things that we might be able to do. You know, if you've been thinking about your investments or perhaps a retirement coming up, or maybe you've been changing jobs, you could really give us a call at Legacy Wealth Management. Our phone number is 701-365-8083. Here's the deal. It doesn't cost anything to come in and see us. We're happy to see you, and we'll give you some help, or we'll at least give you some advice and help you do some things that you may want to do. So that's my thought for today. We're happy to have you with us. Legacy Wealth Management's Investment Talk TV. Don't forget that you can always catch us on YouTube if you miss us live, and we'd love to have you do that. In the meantime, sit back and relax, because Dave and Devin have got some great questions that people often ask when they come in and see us. And we've also got a good look at what happened in the stock market this week. We call it the Stock Market Snapshot. I think you'll find it very interesting and informative. And don't forget, you can always come in and see us right here at Legacy Wealth Management. By the way, we're going to be in Bismarck this week, and we're going to be meeting with people. And if you're in that area and would like to get in touch with us, give us a call. That phone number again at Legacy Wealth is 701-365-8083. Thanks a lot. Now for Devin and Dave.
Here we are, stock market snapshot. Here we are in the middle of July already, if you can believe that. And the market, as hot as the weather has been here in the Red River Valley and the upper Midwest, the stock market has been pretty hot too, with all kinds of news flooding to us. One of the biggest pieces of news that we were expecting this week is the inflation report from June, Dev, and unbelievable. So the largest month-to-month decline in inflation since 2020. We got to go back to the pandemic days before inflation actually fell pretty far, pretty quick. That being led by those gas prices, obviously with the conclusion of the conflict in Iran, which of course re-escalated here recently. But oil prices did come down very sharply June into July, and we saw that reflected in that CPI, that Consumer Price Index report, going from 4.2% year over year down to 3.5%. So the single largest jump month to month since we've seen in basically 6 years. So pretty incredible things. Obviously, it's very volatile. We use that word every single week, with gas prices starting to creep back up again, with the conflict over in Iran and the Strait of Hormuz becoming a thing. One catalyst, though, with the CPI report that kind of got buried by that energy price coming down is groceries and housing actually accelerated ever so slightly. So not very welcome news right now. The Federal Reserve still kind of on that holding pattern as far as interest rates to try to curtail that inflationary period. We'll see kind of how that pans out. But speaking of inflation and interest rates, banks are in the news, Dev.
Yeah, that's right. Banks are kicking off earnings statements here, and they've kicked off with a strong start here. We've seen banks such as J.P. Morgan, Goldman Sachs, Bank of America really kick off this earnings drive positively, beating earnings expectations. Part of what's been driving that is robust investor trading, and along with investment banking, we've seen big IPOs such as SpaceX, which was the biggest ever IPO. We're also going to see big IPOs potentially later this year or early 2027, which would also positively affect the financial industry. And they've really helped the broader market gains early on here in early earnings seasons. And we're going to continue to see more earnings in the next month here, including AI and chip makers. And we saw one recently this week, ASML, the European chip equipment maker. They beat expectations as well, which helped reinforce the optimism about the AI spending we've seen. Investors have been concerned lately about the amount that these chip makers have been spending versus how much they're making but ASML beat expectations. So we'll continue to watch earnings moving forward on the AI and semiconductor chip maker field. And then in the coming weeks here, they will, I believe, have pretty sky high expectations. So we'll see if they can meet what Wall Street is expecting out of them. But speaking of earnings and AI, we saw a company get pretty negatively beat by the AI trade, didn't we?
That's right. Yeah. Speaking of that AI trade, believe it or not, a lot of this money that is flowing into the artificial intelligence and those technology stocks that have to do with AI, that money's got to come from somewhere. And unbelievably, IBM, International Business Machines, saw their single largest daily decline in their history, over 20% down in a single day. Why? What happened? Well, the company came out prematurely and said, hey, we're kind of ratcheting down our expectations for our earnings because a lot of the software development that IBM does, a lot of their customers were shifting a lot of their investment strategy to the artificial intelligence realm to kind of produce this software on their own. So we're starting to see different sectors of the economy with an outflow into that of artificial intelligence arena. Obviously, the valuations of some of these companies is at the forefront of Wall Street right now. That's why we've seen so much volatility. The question becomes, how much higher can we go? And so far, we keep going a little bit higher with the artificial intelligence and the technology stocks, and technology historically outproducing or outpacing the S&P 500 pretty handsomely. But with Wall Street kind of focusing on that, what are we looking to in the future? Well, we just got started with earnings season with those banks, as Devin just mentioned. A lot of the companies still here left to report. We're going to see the overall health of the economy. What does that mean for you and your portfolio? Well, guess what? The AI trade not really going away, not showing any signs of deterioration. Wall Street monitoring that very closely. When it comes to the interest rates, for those of you that might have fixed income investments where interest rates obviously is what the catalyst is that drives those prices for that fixed income, remains to be seen with inflation coming down. Wall Street reacting pretty positively earlier this week by ratcheting down those expectations for immediate rate hikes coming up here in the future. Speaking of the Federal Reserve, Kevin Warsh was actually in front of Congress answering questions as he's required to do. So very interesting sort of dynamic that we're getting here moving into the late summer months. Second quarter earnings kind of rolling out here day by day. The financial industry is still very healthy. The consumer is still spending. So all really good signs for a growing economy in a bull market. We're pretty positive about that. If you've got questions on your portfolio, maybe I should be shifting things around and kind of where do I want to be in retirement? Those are questions that we help with. So give us a call, 701-365-8083. With that, on to our main topic. We're going to dive right into our main topic today. We're going to talk about the frequently asked questions, the FAQs of legacy wealth management. Some of the most popular questions that we get from our clients and prospective clients, and even just our viewers, maybe like yourself, you might have a lot of these questions. So let's go ahead and dive in with our first question. First question is, do I have enough money for retirement? If that isn't the main question that is on so many people's minds out there, and the ironic part about that question is it's actually one of the last questions we can answer. It's one of the first questions people come to us with, but the last ones that we can possibly answer. How in the world could that be? Well, there are so many other questions that we would have to ask before we can answer that question. For example, if we're saving for retirement, how much do you need? Well, it depends on where you're starting. How much are we starting with? How old are we? When do we want to retire? What does our spending look like in retirement? Do we need insurance to kind of protect ourselves? Do we have a mortgage? What's our liabilities going to look like? As you can see with just those few fundamental basic questions, there are a lot of other questions we have to ask as financial advisors before we can ever answer that question. But if you were to Google it, and there's a favorite topic for a lot of people, if you were to Google that question, one of the main answers that you get, the guideline, if you will, is when we get into retirement and we start pulling our funds, whether it was from an IRA or maybe at work, a 401k, 403b for those of you in education, wherever the source might be, the cookie cutter rubber stamp answer is about 4% withdrawal rate per year is what you can sustain yourself on. Now, again, this is a complete guideline. That's going to depend on how much you're starting with to go into retirement. It's mostly going to depend on what you're invested in and how the market is doing at that particular moment. As we all know, the market can go up, the market can come down a little bit, but at the grand scheme of things, we're putting together a big plan to answer that question, how much do I need in retirement? And what we might need on day one might not be what we need on, say, year 5 of retirement, as healthcare can become an issue. Inflation can definitely become an issue where what works on year 1 might not work on year 5. So one of the big things that we try to do at Legacy is to answer all those preliminary questions, get a solid game plan going, and answer that question, do I have enough to retire on, at the very end. So if you're interested in having this question answered for yourself, we'd love to hear from you. Give us a call, 701-365-8083. Here's Devin with question number 2.
Thanks, Dave. Here's another question we get all the time is, when should I take Social Security? Now, a lot of you guys may know this, but I'll recap just so everybody's on the same page. You can start taking Social Security as early as age 62, and you can wait to get the full maximum benefit at age 70, and you can start taking it anytime in between. But once you take it, you're essentially locked into those payments. You will get cost of living adjustments each year, but you're essentially locked in at that point once you decide to start taking. Now, a couple things you should think about when you're making that decision is, am I working full time? Am I retired? Am I working part time? And also health can be a big factor too. Obviously, the longer you wait, the bigger your payments are going to be, but the earlier you start, you're also going to get more of those payments. So here's an example to kind of think about. If you were to wait till age 70, you will get the maximum payments. But if you were to unfortunately pass away a year later, in that scenario, you would have been much better off taking it at age 62 versus waiting till age 70. So there's a couple things like that you want to keep in mind, and it could be worth talking to a financial advisor. At the end of the day, I think the important thing is, if you feel like you need it, take it. Don't wait.
Thanks a lot, Devin. On to question number 3. This question we get asked a lot at Legacy Wealth Management. All of our clients kind of are in this sort of situation at least one time or another, especially early on in retirement. And that question is, should I use my retirement assets to pay off debt, or should I continue or add to my investments? Such a powerful question. Let's get right down to it. When you break it down, the cookie cutter answer is, it's going to depend on the interest rate and the outstanding balance of the debt. Well, let's use an example. Let's say a retired couple out there might have a mortgage on their home. And let's just say it's about $200,000 remaining. If that interest rate on their mortgage is, say, between 3 and 6%, kind of where the average would be right now amongst retired couples that do have an outstanding mortgage, and depending on what their retirement assets are, if you are invested accordingly, and with the returns that we've seen of the stock market the last year, 2, 3, even the last decade, chances are the returns that we can see in those retirement portfolios would outpace the amount that we would need to withdraw to pay off the entire mortgage. Let's say it's a mortgage. In that example, if we were to pull out $200,000 from a retirement account, if we assume that it is a pre-taxed account, in other words, taxes have not been paid, you're going to need to pull out more than $200,000 to pay off the mortgage, because taxes are going to become an issue. Now, once the mortgage is paid off, the argument becomes, hey, we no longer have that $1,500 or $1,200 or whatever that mortgage payment might be per month. However, your retirement assets have now shrank because we pulled out $200,000+. That's $200,000 that is no longer in the stock market or the market in general, working for you to give you an extra income boost later on in retirement. The joke sometimes often is, if you need money and you've got a paid off house, you can't exactly sell your bathroom if you need cash, right? So we want to make sure we have enough liquid assets available. When we invest in the stock market, yes, we're going to see those rises and those little bit of dips. But when we zoom out, we want to grow the account faster than we are withdrawing it. Now, you might be saying, well, if I take that mortgage, I don't need to withdraw as much. And that is true to a point. But when you run the numbers and we look at 5-10 years from now, very, very rarely does it not benefit the client to stay invested and continue those monthly mortgage payments. There's nothing to say that you can't throw in an extra mortgage payment or two. As a matter of fact, that might be some good advice, depending on what your situation is. So we're not really saying yes, pay it off, or don't pay it off. It's going to be very specific to every single retiree out there. But when it comes to paying off any sort of debt, the question becomes, what does it cost me in the future in order to pay off that debt today? And 9 times out of 10, what it's actually costing you in the future, including keeping those monthly payments in play, it actually costs you a lot more to pay it off. So it's definitely worth taking a look at. It's something that we help with our clients every single day. So you should give us a call, 701-365-8083. If this question is kind of rolling around in your mind and maybe you have some outstanding debt that you could pay off and you're wrestling with that decision, give us a call at Legacy. We'd love to help you. All right, Devin, question 4.
Here's another question we get asked a lot is the stock market too risky? Now, I think a couple things we want to talk about is risk is subjective, right? Everybody might have their own opinion about what risk is and how much risk they can take. Something we talk about a lot is risk versus volatility, right? Volatility is something goes up in price, then it goes down, then it goes back up, right? That's a little different than risk. That volatility can create opportunities to buy low and sell high. Now, when it comes to risk, there are ways your financial advisor can reduce risk for you. One is being to diversify, right? We hear the phrase all the time, don't put all your eggs in one basket, right? A financial advisor will create a portfolio for you that is in different parts of the market, because certain parts of the market do better when the market does well, and others can do better when the market's not doing very well. So having protection and growth in there is extremely invaluable to have. Now, when we talk about the market being risky, the stock market has historically performed about 10% per year. Now, that doesn't guarantee that it's going to in the future, but I think it's important to remember that includes all the historical downturns we've seen, like the 2008 financial crisis, COVID, the dot-com bubble, the Great Depression, right? All of that's included, the good and the bad. It comes out to about 10% per year. But at the end of the day, your goals should dictate the investments, right? Are you meeting your needs now? Are you meeting your needs in the future? So when you ask yourself, is the stock market too risky? I think it's important to ask yourself, are you in investments that are helping you meet your needs now and that are going to meet your needs in the future as well?
Thanks a lot, Devin. All right, question number 5. Here's another big frequently asked question that we get. And we get this question more often than not from people who are actually just about to retire or saving for retirement. And that question is this: how do I save on taxes? Talk about a loaded question. The answer to that question is going to depend entirely on the situation. Kind of like the very first question we had of, do I have enough for retirement? It's going to depend on a lot of different things. But let's use an example. So if we've got somebody who, say, is in their late 50s, thinking about retiring in their early 60s, somewhere in there, and if they're a business owner and they're thinking about liquidating their business as part of their retirement plan for assets in retirement, that's going to be a very different story from, say, somebody who's got, kind of that 9-to-5 job contributing to a 401k. Their tax situation is going to be very different. When it comes to saving on taxes, all the funds that we put toward a pre-tax sort of retirement account, we get to deduct from our income taxes in the year in which we do that, right? So that is going to help on tax savings. But what about people that maybe have invested money, whether it be in a business or even just a regular investment account that's not necessarily a retirement account, which is taxed differently? How could they save on taxes? There are plenty of investments out there that are very tax efficient, and that's something that we can help with at Legacy Wealth. But in a nutshell, there are plenty of investments out there. Some of them are even tax-free on their income they can produce, which can be a really nice supplement, especially for those people that already have a higher income tax bracket, that maybe they're in their 50s early 60s, the most money they've ever made in their life at the peak of their careers, right? Or at least at the tail end of it. We want to try to limit that income as much as possible, because as we climb up that ladder, income taxes go up, right? So we want to try to avoid that. When it comes toward saving on taxes in retirement, we want to avoid large distributions from those pre-tax IRAs. Every penny we pull out of those accounts really pushes up that income tax. So we want to limit that as much as possible. We have Roth IRAs, which are an option out there. So if you're in retirement, you have your Roth IRAs with certain parameters that have been met, you can withdraw from those. Not one penny goes to Uncle Sam on those. That can be a huge help with those income taxes.
Here's a question I got asked recently that was really interesting to me, and that's, what is the biggest financial mistakes you see people make? I think one of those is not having a financial plan, or pushing off that decision to meet with a financial advisor or a professional to come up with a plan. If that sounds like you, that's okay. There's a lot of people in the same boat. We get it all the time that people have been watching us on TV for years or listening to the radio for years, and they finally made that decision to come in. So you're not alone. I will say there's no time better than the present to make that decision. The longer you wait, you might be limiting your options in the future. Your portfolio is not going to have that chance to grow. And it's really valuable if you're making a big decision in life, especially when it comes to your finances, to have a professional be able to help walk you through that. The economy is also constantly changing. We see big headlines on the news all the time, and it's just really helpful to have a professional be able to walk you through those situations. It's easier the more you stay ahead of those things. Another thing I see a lot is people trying to time the market. Now that's pretty risky, because not even the professionals have a crystal ball, and if they tell you they do, they're lying to you, right? Nobody knows what's going to happen tomorrow as a guarantee. At Legacy Wealth Management, we are long-term investments. We firmly believe in the value of being invested in the market for long periods of time and focusing on the big picture, right? So we're not as concerned about what's going to happen tomorrow or next week. We are concerned about that, but what we really want to focus on is, are we putting ourselves on a path a year from now, 5 years from now, 10 years from now, that our portfolio is in a spot where we're meeting our needs in the future, and we're going to be able to do what we want in the future. It's really easy with all that big headlines we see in the news about worrying about what's going to happen in the market tomorrow. Is it the right time or not? There's always a right time to invest. There's always different things that are going to perform better at different points in the market. That's what having a financial advisor is for, is to take some of that pressure off of you, so we don't have to worry about the timing too much. We want to focus on the big picture and the long-term plan. Another thing we see a lot is people kind of overlooking what inflation can do to a portfolio and how that can eat into your returns. Inflation right now, with everything we've seen with Iran and the oil prices, the supply shock we've seen, and potentially interest rates raising, we've seen inflation around that 3% right now. So if you've got an investment out there that's sitting around 2%, 3%, 4%, that 3% inflation is really eating into your purchasing power moving forward, because gas rises in the future, healthcare, property taxes, food, all of those things get more expensive the more time goes on. So that return you're getting is barely keeping up, or maybe even losing to inflation. And remember, with those 3% return, 4% returns, depending on what type of account it might be taxable as well. So what you're taking home is actually less than that 3% or that 4% or that 2%, whatever it may be. Now, I'm not saying those types of investments are wrong for everybody. There are certain scenarios where those do make sense. And at the end of the day, your goals dictate the investments. So meeting and talking to a professional is a great idea to find out if those investments are right for you or not. Those are basically some of the main decisions or mistakes I see people make. So again, if you've been pushing off that call to come into the office and meet with a professional, I think there's no better time than now. And that phone number is 701-365-8083.
How much risk should I take when I invest? And this question, again, to kind of keep harping on the same drum we've been beating, it's going to depend on your situation. The risk profile needs to fit the goals just as much as the goals need to fit the risk that we're taking, right? And we don't really like to use that word risk. We've said that many times here on the program. We are willing to sacrifice some volatility in there, and some volatility is a good thing, right? When it comes towards your retirement and what we're trying to build, the amount of risk that we take is going to depend on the goals, right? So if our goals, say we're in our mid-50s, let's use an example. We're in our mid-50s, we got, say, 10 years to go before we're going to be fully retired. 10 years is still quite a long time to grow your portfolio, especially if you're continually adding to your portfolio and saving for retirement. Because if there is a downward trend in the market, you are still adding, which means you're buying into the market at a lesser price. So a year, 6 months, 2 years from now, whatever the case might be, the market will kind of reaccelerate as it has over history. Now, past performance never dictates future results. We often say that. But with a 10-year time horizon for retirement, that's still a lot of growth years. So at Legacy Wealth, we don't necessarily subscribe to the default setting that as we get closer to retirement, we're going to shrink our risk profile, right? It all depends on where we are in the market. If we feel really strongly about the stock market, which we do, and we feel that these companies that we're investing in, these large companies, are going to continue to grow at a really healthy pace, we're going to take part of that, right? We're going to recommend to do that. So if the question is, how much risk should I take? The real question could be, what do I want to avoid happening? And these investments that we have at Legacy Wealth that we use with all of our clients, there are plenty of things that we can do to protect you on the down end while we are continually adding to grow that portfolio to get you that income that you're going to need in retirement, right? We also want to beat that word inflation. And guess what? Investing, the more conservative the investments, the more of a risk inflation becomes to the value of our portfolios. Our purchasing powers begin to shrink unless we invest accordingly. So how much risk should I take? It's going to depend on you and your situation. If that's a question that you've got and you want to learn more, feel free to give us a call. Come on into Legacy Wealth. It doesn't cost anything. 701-365-8083.